Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Welcome everyone. So we are now up to Unit 4. I want to start off by giving you guys a little bit of context on where we are now, why we've taken the path we've taken, and what we have ahead. Because if you think back to early finance courses, one thing that was relatively easy about them is that they were quite linear. I mean, foundations of finance, you had three completely distinct topics: time value, money, diversification, and arbitrage. And in each week, it was tied to a particular part of the text. It was a very self-contained topic. You had your lecture notes, the textbook, the few questions, and that was it. And then you moved on. Portfolio construction is different because it's based in the real world. And in the real world, every concept is related to other concepts, draws on examples from different areas, requires a depth of understanding that can't really be gained in an individual way. So the way I think of portfolio construction is not taking a journey down a straight path. It's that you have a puzzle that you are slowly filling out, and with each additional week you are understanding more about portfolio construction in general, about what you've learned in prior weeks, and also you've got a better context that will help you understand what's going to happen in future weeks as well. So some of you at times might feel in a particular lecture like we're drawing on concepts that you don't yet fully understand. You know, I spent a lot of time last week talking about the issues with smooth returns because it's been trading or appraisal valuations. We're going to talk about that more today, and I'm actually going to show you an Excel example in the workshop tomorrow. I talk about hedge funds. We don't even look at hedge funds in depth until week 8. So if we do talk about a concept that you don't yet feel like you fully understand, it's because I'm bringing in things from later weeks to start to give you that understanding now. You'll then fill in the understanding more and more as the weeks progress. Then when you go back and revise, the examples that we talk about now will make complete sense to you because you'll have that extra depth of understanding. So because of that, I think it's really important to understand where we are now and how that's going to tie into what we have in future weeks. So before we go into the actual content of today, let's just sketch out what we've done so far. So I'm going to start us off by saying that essentially in week 1, we gave an overview of multi-asset class portfolio. So if you think about a big bucket, this is going to be a bucket if I can investors. Now, this one gave you an overview of what portfolio construction was and sketched out the week ahead. What type of things, when we talk about this, did we consider? I know it was like nearly a month ago, but if you think back to week one, what type of things did we talk about? We talked about the different asset classes. Because that is where this money is going to go. What else do we talk about? Investment preferences. We introduced the importance of investment preferences. Yeah. What about that? There was a diagram. What does the diagram talk about? It was, yeah, it was a process of forming portfolios. And also the key players in the industry. Right? We talked about the fact that it wasn't just one type of fund that would have a multi-asset class investment strategy. It could be a superannuation fund, it could be an insurance company. We looked at all the different types of aggregators, so sovereign wealth funds, endowments, foundations, charities. We spoke about the fact that within insurance it could be defined contributions or defined benefits. We spoke about the fact that on the retail side we have a self-managed super fund as well. And we talked about the key players in terms of a chief investment officer, the investment managers. We talked about governance a little bit, so we're going to come back to that at the end of the week. But it was really just providing a broad overview of the type of tasks that would be required in portfolio construction. Once we have our pool of money, what we need to ask ourselves is how do we invest this money? Now say that we have decided our governance structure, we are set up as a fund, we have the money already, and we need to, consider this not like my document come away. We need to decide what to actually do. Before we go about deciding what asset class we want to put this money in, what is the first thing we need to consider? Investor objective. We need to say who is our investor. Investor, that's an hour, sorry, who is our investor, and in particular, what are their objectives? Because even though our goal is to allocate this money between different asset classes to earn a return and go back to the end investor, we can't start that process without knowing what it is our investors want out of the portfolio. Why is investor objectives so critical? Why can't we just ignore who and just go to what? How to invest?
Because it depends what asset allocation becomes the investment objective.
Yeah, because that's right. I mean, different investors will have completely different asset allocations that are suitable for them. So the worst thing to do would be try to tell somebody this is what a portfolio should look like without understanding who they were talking to. And people do, they throw out these rules, 70-30 rule or 60-40-10 rule in terms of equity, fixed income, cash. But ultimately, without knowing your investor, there is no rule that's right for them because it's got to be tailored to their preferences. So what is some, and by the way, because their objectives differ, that also means that their key risks will differ, and so will their risk preferences. So, what are some of the key risks that investors might take? And I'm going to put the first one down. we can't diversify that as well. But we also said that in reality, there's a lot of other risks that will matter to an investor, and different investors are exposed to different risks. So what's another risk that we looked at in week 2?
Jobs, the industry.
Jobs, yeah, absolutely, job risk. And in particular, we looked at that in the context of diversification. In that if you are highly exposed to a particular industry through your career, you might want to diversify some of that risk away within your actual, for example, superannuation fund or personal portfolio. What other risks? Illiquidity. Which would be a massive issue, particularly if you need to get that money in a hurry, or if you're a fund manager and you need to buy the money in a hurry. So if you're managing an open-ended fund and your investors suddenly come up and say, I want to redeem a lot of money, you have to sell assets in order to satisfy the redemption. If they're liquid, what would you risk doing when you sell a liquid asset? Taking a haircut, exactly, and ending up with a significantly worse return. Now remember, that haircut reduces your return, which is recorded. So when investors see that you've taken a haircut so your return is poor, what's the risk there? It happens because of redemption, so you have to sell off, take a haircut, and returns go down. What might happen next? Yeah, exactly. If your investors will jump ship, you'll have more redemption, so you'll have to sell off more assets. And your return will go down, and the risk is that you have more redemptions again. So you have a run on your fund. And the same risk happens, by the way, in terms of things like company share price. But at least for the share price, you have a secondary market where the company themselves is not providing the cash. With an open-ended fund, you are. What if you're a fund manager? What's another risk you might take? Personnel risk. Person risk, the risk of people, that's the personnel, I cannot spell that. The person kind of work. So that's right, the risk that you have a fund manager that's doing incredibly well, starts going through personal difficulties, and that, those personal difficulties start to affect his outlook, his mental space, and therefore his performance of work. Your returns start going down. That's one manager. Remember, they have competitors. So what's another risk that a manager would face in relation to competitors? Peer risk. All these different risks that are more than just market risk and need to be considered because they will affect different investors in different ways. And this isn't an exhaustive list, so I'm going to put an etc. here. Don't write that as this is all I need to revise, right? This is just reminding us what we actually cover. So before we have different investors, they have different objectives and different key risks and risk preferences. So when you make your assignment, it will be very specific. In fact, I'm thinking I will actually use you two investors so you can see how much you can tailor a portfolio to suit that. You might, and I haven't finished the assignment yet, so I'm not actually saying this is going to be your investor, but you might have an investor that says, I want you to focus on maximizing returns, but I don't want any more than 25% of my money in illiquid asset classes. I have a strong preference for Australian assets, so I would like at least 50% of my funds, of my money, or in fact, might be even 70% instead of from about it, 50% of my money invested in assets domiciled or based in Australia. And I have a large exposure to property in my job, so I want a low exposure to direct property. I am relatively conservative, so I don't want the probability of loss to be any more than 7-8%, whatever the number is, and I do care about the performance of the median peer group. So I want the probability of underperforming the peer group to be no more than 6%. Or I'm willing to continue to underperform the peer group by, say, 2% per annum, but I don't want that likelihood to be more than 10%. Whatever it may be, these are very specific objectives that you're going to put into your asset allocation problem, and that is going to affect the result that comes out. You might have an investor that says, look, allocation would be very different. So it's really important to understand what it is your investor wants and to prioritize their investment. Once you have that, you can then set up your asset allocation framework. Now, remember, asset allocation is not a science, or if there is some science within it, but it's also very much an art. There's no one right way to do it. There's no one right portfolio. So far, we have focused on one particular method in week 3, last week, one method of asset allocation. Does anyone remember what was it? Oh, I don't remember one, but what was that? Mean variance optimization. Which is grounded, remember, in modern portfolio theory. Now, what would you say one of the key takeaways was from last week in terms of an issue with mean variance optimization? There's a risk that they get. If you don't control your optimizer, there's a risk that you'll end up with a not well-diversified portfolio. In fact, it could even be an extremely undiversified portfolio with, as we saw, some short weights as well as long weights from different asset classes. Now, why? What is mean variance optimization so sensitive to? Why can it end up with these crazy undiversified solutions? Can anyone think of an example of asset class where we said not to be really careful under mean variance optimization? Direct property. What's the risk with direct property? Underestimate the risk, right? The risk with direct property, because it's appraisal a base valuation, is that returns are smoothed if you use, say, quarterly frequency of data, or even monthly, because the appraisals only happen every year. If you understate your risk, you will overestimate your expected return per unit of risk, so the optimizer will want lots of the asset class. That's exactly the issue. What we call it is we call it hypersensitivity to asset assumptions. Expected returns, variances, covariances. Well, the issue. Hypersensitivity to asset assumptions. Which means we need to control our optimizer as best we can if we are going to use optimization. We also said if you want to avoid optimization but use the principles behind modern portfolio theory, you typically use those methods to justify, define risk in a portfolio context, correlation matters. You can use that as a base of a portfolio analysis workflow. But what's the issue of a portfolio analysis workflow and avoiding optimization altogether? What's one of the frustrating things about doing that? So when you run optimization, what's one of the easiest things about it? It's automatic, right? Yeah, you just hit a button and it goes. Whereas if you use a portfolio analysis workflow, you have to make a small change, see if it's an improvement, analyze why, maybe try to stick with it, look at it again, go what the numbers will change it, see whether the numbers improve each time. It takes forever. So there is a tendency to want to use optimization because it's automatic. You just hit run. But you've got to be very careful in terms of making sure your optimization is sensible. Now, at the back end, when you're actually doing the optimization, we spoke about the fact that what you should do is put in controls to calm down your optimizer. Have a tracking error constraint, for example. Put in, so that's tended to the benchmark. Put a maximum weight on an asset if you think the return is smooth. But the other issue is at the front end, and that's that optimization is only as good as those input assumptions that you make, right? The expected returns, variances, covariances. And that is what we're going to look at today. our investors matter. And the most common starting point to do this is the various optimizations. But given it is so hypersensitive to your input assumptions, we need to be very careful in how we form those assumptions to begin with. So that brings us to today. Today, this topic can seem right because it is very much focused on data. I actually think it's one of the more interesting topics because you don't just think, oh, I've got to make my decisions. You think about why and how much those decisions are going to matter when it comes to your actual allocation. For those of you that like to be told an exact solution, and I can sympathise with this, unfortunately this isn't the week for you because remember how we said portfolio construction is a science and an art? This week is very much about the art. Because you're going to have a huge amount of choices to make. And the fact is there is no one right choice. What you believe will happen in the asset classes will affect the decision. Who your investor is will affect the decision. The data that you have will affect the decision. There's no one right way to go about it. So what will really matter is your justification as to why. Now I'm going to come back to the justification in a moment. But let me just fill out the rest of it and then we'll come back to week 4 and I'll switch to another colour for what we have ahead. We're going to see that the issue is that the various optimization is very sensitive to the choices that we make. So what we're going to do in week 5 is look at alternative methods of asset allocation. Some of these methods will be less sensitive to our asset assumptions. Some of these methods will be more qualitative in nature, so you don't have the issue of an optimization being oversensitive to the data. But in all cases, whatever method you use, the choices you make will have an impact on your outcome. So one of the things we're going to say today is you might want to avoid relying on a single method. And in refinement, that's what I'm going to ask you guys to do. I'm not going to ask you to use one method, I'm going to ask you to consider them both before combining them to come up with a recommendation for an asset allocation. So that is essentially, if you might be to consider that a breakpoint in the course, which is why it's only up to there that it's covered in the international exam. Now, as we've gone through so far, and I'll continue to do over the next couple of weeks, I use a lot of examples relating to the specifics of an asset class. You need to understand the tools to make your asset allocation. But what you then have is your qualitative overlay of judgment. Remember we said, don't ever let an optimizer, don't ever let a machine make the decision for you. You need common sense to come in afterwards and say, is this allocation sensible? We've already started talking about the type of things you might consider. But what we're going to do from week 6 on is really develop our understanding of each individual asset class so that the example I've given you becomes part of a complete picture for that asset class. So that means that when you figure out your asset allocation, some of it might be in equity. Well, we're going to do that in week 6. Some might be in fixed income, which we do in week 7. Some will be in alternatives. In week 8, we look at direct property and infrastructure. In week 9, we look at hedge funds, private equity, and commodities. And in week 10, we look at whether we go local in our investments or global or both. And we look at the issue of currency hedging in overseas investments. Then we finish it off in week 11 by looking at how you actually implement these investments. And in week 12, we look at other topics that are important to consider that don't really fit anywhere neatly like that. So, what you can see is what we're doing at each point is we're filling in the broader picture so that by the time we get to the end of week 12, we understand each topic, but also how they interrelate. And it's the connection between the topics that deepen our understanding and mean that we fully grasp the asset allocation decision. So think about this part is learning the tool. Think about this part as deepening the understanding that will enable us to use our intuition, our common sense, our judgment in making sure the tools are working in a way that's sensible. So let's come back to today and this issue of forming asset assumptions and how important choices are. I think this is actually the reason that this topic is one of the most interesting weeks. The reason I want to stress it is if you just think, oh God, do I want quarterly or monthly or yearly data? You sort of think you care, right? And the answer is you should care a lot because, oh my goodness, it's going to make a difference to your investors, possibly to your livelihood, and certainly to your asset allocation. So I'm going to give you guys a bunch of choices. It doesn't matter what you say, I'm going to frame this to show you the risks, okay? So don't worry about there being a right choice, there isn't. But whatever you tell me, I'm going to make some decisions from it. We're going to come up with a couple of asset allocation methodology decisions, and then I'm going to tell you some of the problems with it. Let's start with measurement interval, and all of this, by the way, is going to relate to that. What do you guys want to use? You can pick one for me. Do you want monthly data? Do you want quarterly data or annual? We go yearly data. There's no right or wrong with us coming up with the example. You guys, whatever you pick is the example I'm going to give. Yearly, we've got one. What about quarterly? Few more, okay. What about monthly? Okay, monthly is the winner. You guys are asset allocators, you have chosen to use monthly data. Alright, now the next thing you're going to decide is what is my sample period? You can have, let's be sensible and have the data going up to today because other groups most of it. So we're going to have data going to 2017. The decision is to be started in 1980, 1990, or 2000. We go 1980. A couple. Who wrote 1990? A couple. Who wrote 2000? Okay, pick one 2000. Great. 2000 to 2017. Arguably, the most relevant period because time is changing and evolving. But it is going to come with some potential downsides as well. I will talk about what they are. Alright, so now we're going to look at a couple of different asset classes. We're going to look at cash. We're going to look at hedge funds. And we're going to look at direct property. I'm now going to tell you some of the choices that you've made, like some additional choices that you've got to make. Now, as I mentioned, if you guys can see problems with it before I come to the problem, that's when you give yourself a big pat on the back that you're already intuitively understanding and relating to some of the choices you have to make today. Cash. Alright, well for cash, what you're going to do to figure out what you expect the return on cash to be for the next period is you're going to calculate your expected return as the historical average of what it's been between 2000 and 2017. Hedge funds. You have quarterly data from, I think it's from the mid-2000s, so let's just use that. Therefore, from 2000, so for the early 2000s to mid-2000s, you have yield. When you have quarterly data, remember you've chosen monthly, for hedge funds as a whole index, you don't have a good data series for monthly return. You can have individual hedge fund returns on a month-by-month basis, return from the price series that you download. Okay, so you make these steps.
For the quarterly data in 2000, you mean divided by 3?
Yes, I do. Thank you. Sorry. Divide by 3. Thank you. So you've got 3 months when you have the same return, and then 3 months, 3 months, 3 months. For 400 years. God, I'm good at math today. Everything. Spelling, math, brilliant. Alright, so you divide the quarterly by 3, the yearly by 12, because there are 12 months for this year. You make these decisions, you make decisions on a bunch of other asset classes, you come up with an asset allocation. Unfortunately, your asset allocation does not do very well. So now your bosses and your investors are demanding an explanation. They start looking into the decisions you made to estimate your expected returns, variances, and trade variances. And the first thing they see is, alright, cash, you use a historical average. Let's have a look at cash returns in Australia. This is video 1. You picked that you wanted to use returns from the year 2000 onwards, and you use, thank you. This is Excel video 1. See, we're in the cash column. You decided to use returns from 2000 to 2017. Well, I told you this. And I told you that you decided to use the average of the past as a representation for the future, which is, by the way, one of the methods of estimating expected return. The average return on Australian cash from 2000 is 4.5%. So you argue that the return on cash next period is 4.5%. Not as bad as it would have been had you gone back into a longer history, which I'll talk about in some slides. But the first thing they're going to say is, well, alright, you said I'd get a return of 4.5% on cash. Have a look at what it's been for the past few years. Why on earth is it going to go back to what it was sometime in 2012 when it's been steadily dropping? So you're saying that it's suddenly going to make up 5 years worth of interest rate cuts. Pretty unlikely. So that's the first reason why your bosses, your investors are not going to be very happy with you. You're then going to look at, you're going to say, well, look, I have hedge funds. I didn't have monthly data, so I split it up between, I took the quarterly and the yearly returns and split them up to spread between the months. And they say, okay, hedge fund data, is that IIC normally distributed returns? And you say, no, I guess not, because first of all, the fee structure of hedge funds is non-linear. We're going to look at that on week 8. Second of all, they can invest in options, which creates skewness. So that is violated. So I have very little justification for taking the returns and just splitting them equally over the data series. Not to mention it will have an effect of smoothing my volatility if I'm not there. So that's pretty hard to justify as well. And then you get to direct property, and they say, well, all right, you use monthly returns, and most direct property assets are only valued every year. You're smoothing your returns, you're understating your risk, so you make up investors a bunch of money in direct property. That's not going to make you very happy either. Okay, so these choices, they're not just choices on a spreadsheet. They're choices that are going to amount to real money that's going to end up in real returns. Now the fact is, even if you carefully justify every choice you make, you could still lose money. But you need that justification, because when someone comes to you after the fact that a market's bad, and they are bad at times, and says, why have you lost my money? What data choices did you make? How can you justify it? You need confident, calm, well-justified solutions. 1 for your own peace of mind, and 2 for your investors, if they're ever going to have confidence that you'll regain the money you've lost. You can't come about and get caught out by saying, oh, I guess I didn't really think of that. So when it comes to your assignments, when it comes to your career, if you're in the industry, every decision you make needs to have a choice behind it. So when you have a look at, for example, Excel video 2, this is the unconstrained optimization. So far, you might have just sort of looked at this data that you've used. And I can understand why you might not have thought much about what went into it, because we haven't yet covered it. What this topic is about is understanding why decisions are made, because everything you see here comes from a decision. The decision to use monthly returns, not quarterly, not annually. The decision to start your analysis in 1985 and continue through to the end of 2017. The decision to calculate expected returns as the historical average of what's occurred in the past. Once you go into your last optimization exercise, the decision to adjust your expected returns using your investor forecast, which is another method we're going to look at today. The decision to put a cap on direct property. Every decision is going to result in very different asset allocations, as you saw if you've gone through the Excel work from last week. So with that context, we're just going to dig into each of the different choices that you have to make when it comes to figuring out your asset assumptions. And it's not about me telling you what to do, because what to do is going to depend on the case. It's all about me telling you or helping you to understand how to think about the decisions and how to tailor them for the purpose. Because as long as you can explain why, and that explanation is reasonable, there's not one right way to go about it. So in your assignment, you will decide a data frequency, you will decide a time interval, you will decide a method. You need to justify those in your write-up. And as long as you can persuade me that your reasoning is sound, it doesn't matter if two groups use completely different intervals, methods, time periods. They could get equally strong marks because they've done it the right way. So these next two slides are just going to give you a bit of an overview of all of the different choices we're going to cover today. So I'm going to go through these at a high level because then we're going to dig into each one of them step by step. But I want you to get an understanding of just how many decisions there are to make. So remember, the overarching decision that we need to decide is what are our inputs into asset allocation. What are our expected returns, our variances, and our covariances? Ideally, you would have some machine that ready to the minds of everyone that exists, averages out what they expect, and pops out a number. We're not in that world. We will probably never be in that world. We need to estimate what we think people think that return will be. And obviously, there's going to be estimation error when we do that. Whatever we do, we always need to start from our objectives. Now, in the context of this week, our investors' objectives will affect our choice of what data we use. Am I a short-term or a long-term trader? If I'm a short-term trader, I don't care about fluctuations over years. I care about fluctuations over days. So maybe I want to use daily equals. If I'm a long-term trader, I might want 1 year return or 5 year return. What about my time period? Do I think that things have changed in the past 20 years so that data from 2000 is the only data that's relevant, which is the decision that you guys made earlier? Or do I think that using more recent data might miss a lot of the fluctuations in the market that happen over a longer period? Let me give you a bit of context about how much this can matter. You guys showed in the example that we did before, data from 2000 to 2017. Right? We're talking 18 years worth of data. So less than 2 decades of data you decided is what you wanted to use. So if I said 70 years of data, that would seem like a huge amount, right? And if I said what matters, 70 or 90 years, what do you guys think? If I said pick between 70 or 90, do you think the decision would necessarily matter that much? I mean, it's a huge history, right? Now, if we took that date from today, it would matter a bit, and I'll explain why, but not that much. But let me give you 2 possible theories. One is 70 years, one is 90 years. The 90-year series is 1927 to 2007. The 70-year series cuts off 10 years either side. So not 1927, but 1937. So let me just write it down. So option 1 is 1927 to 2017. Option 2 is 1937 to 2007. Right? They've got over 50 years of data. It's a massive, massive data series in either case. But by shaving off the front 10 years of data, what can we lose? And the GFC, exactly. They are the single two worst economic events of our history, all because we took off a decade either side. 70 versus 90 years of data, and yet what a difference it made. There were crashes in this time. There was the Asian financial crisis, there was the dot-com bubble. But particularly from about like the 40s, the 50s, the 60s, the 70s, they were relatively smooth. 70s started to have a few other issues with things like stagflation, but they were relatively calm years. So we have in part 2, we have a lot of relatively calm decades that probably aren't particularly good reflections of today. And we've lost the two worst economic events through that. Okay, so you really need to be careful when you make a decision on time, on the time period, that you're not losing some of the key events in your data. You've also got a lot of choices to make. So, for example, you might choose a parametric, so a model-based way of characterizing your returns, or a non-parametric or a data-based return. And what this is going to be the first thing I go into in a couple of slides. The question we're going to ask is, can we model the distribution of returns better than the historical data? Or do we have a way of predicting what the returns will be next period, say, better than just using a historical average? So we'll go into all of the different things to think about in a few slides. Related to this is, do I choose to use IID or conditional time varying returns? Can anyone remember, what does IID stand for? Yeah, identical and independently distributed returns. You know how we say we've got a lot of data choices to make in terms of measurement? Well, in return to IID, it wouldn't really matter if you did monthly or quarterly data. The distribution of returns is the same each period. But we said for hedge funds, you're going to have a skewed distribution because of the fees and the assets they can invest in. You guys told me last week that asset returns typically have excess choices, right? In other words, extreme events happen more frequently than a normal distribution would imply. Okay, so there are a lot of reasons to think. You've got business cycles and trends. So there are a lot of reasons to think that using a normal distribution, a parametric normal distribution, is a problem. And there are a lot of reasons to think that using IID returns is a problem as well. Because in IID returns, you can't have serial correlation. So you can't have momentum in the short term, you can't have mean reversion over 3 to 5 years. You can't have any predictable patterns whatsoever. And we're going to see a lot of cases where that's going to break down. Assuming that returns aren't IID, independently and identically distributed, you need to be careful when you think about things like the measurement interval. Because remember, we saw that if you have serial correlation from 3 to 12 months, your risk actually lengthens as your horizon lengthens with it. But over 3 to 5 years, once you get to 3 years and move towards 5, the downside risk is reduced because you have mean reversion. So your measurement interval in your time period is going to affect the riskiness of your strategy. I spoke about the time period, the importance of ensuring that you capture extreme events. We went all the way back to the Great Depression to get one of those. But let's say that we didn't have data that went back to the Great Depression. Let's say we had data that started in the 50s, right? If you wanted to take data from 1950 to today, the other risk is that you're going to wash out some of the extreme movements because the 50s, the first couple of decades of that period were relatively calm. And if you think about today, we've got algorithmic trading, we've got derivatives, we've got hedge funds that don't need to disclose their strategies. So that means that they can all end up over-correlated, which means they might trigger a rush sell of assets that's going to affect actual asset markets generally. Remember how I said that there was a quant crash or a quant quake in 2007? Can anyone remember what caused that? It was a bunch of hedge funds that had similar strategies and didn't know. And some of the hedge funds had to sell off assets. That caused a drop in their value, so it triggered margin calls and other sales of other hedge funds, and for a couple of days the market dropped. It wouldn't have happened in the 50s and 60s. Assets have changed. So the argument for a shorter time period, like what you guys showed earlier, is that if there is a structural break in the data, so the past isn't a good representation of the present, you might not want to actually go too far back more. So it's always going to be a trade-off. You want the extreme events, but you don't want data that's equal to the reflection of today. And you've also got to decide whether you use real or nominal returns. Now, in this course for the numerical analysis, we use nominal returns. There's a lot of argument to using real returns as well, but it brings in complexities in terms of inflation that are outside the scope of this course in terms of modelling it directly. But we are, when we look at the asset classes, going to start to talk about how different asset classes have different relationships with inflation. What is inflation? How do you define it? Yeah, the decrease in the real value of money over time, or the increase in the price of assets in terms of what you can afford. So if money is devalued over time, you need to spend more and more of it to purchase the same level of goods. Now, think about a long-term investment strategy. You put money in to earn a return to go back to the end investor to the super fund their retirement. Now, you might focus on a nominal goal of 8% per year. But if inflation goes through the roof, that 8% per year return is giving you the dollars you expected, but those dollars can now buy a whole lot more. So it's really important to remember what the impact of inflation on your strategy, and actually to protect against inflation risk as well, if you think it will matter for your investors. Now, if I go back to these asset classes that we're going to look at, and sorry, I have used abbreviations, but we've got equity, fixed income, direct property, infrastructure, hedge funds, private equity, and commodities. Can anyone tell me one of the asset classes there that would provide a good inflation hedge? Derivatives? Oh, sorry, commodities. Yeah, I thought, depends on the derivatives, they would, yeah, but commodities, absolutely. They are real assets. What about another one? Direct property is nothing. It's a real asset again. Typically, your real asset classes will help to protect you against inflation. Within fixed income, there is one type of fixed income instrument that will also help. What would that be? Yeah, inflation is bonds. That's right. We're going to look at those in week 73. So when you start to look at your asset class, this is a qualitative understanding. When you look at what comes out of an optimizer, you say things like too much illiquid assets or is there too high a weighting on a smooth asset class. But you also say, okay, let's look at my asset allocation. Is my investor worried about the impact of inflation? And do I have assets within my allocation that will help to hedge against inflation too? Then you dig deeper, and by the way, we're going to talk about this in week 10. You dig a bit deeper again and say, well, what inflation is my investor particularly worried about? Because if they're particularly worried about Australian inflation, which is the take effect out there consumption in Australia, then you're going to be focused on Australian real assets as well. And that's where commodities start to become a bit tricky because they're typically denominated in USD, but there is a correlation of inflation among a lot of developed markets, so they still provide you with good inflation. Okay, so that's the type of thing. In this course, I wanted to include the real or nominal as a data choice because it is an important data choice. In this course, though, we're going to focus on nominal. But remember that inflation is going to be important. So if you go out to the industry, you might choose the model using all the time. It brings in a lot of additional issues to control for those, partly because you've got to actually anticipate what inflation is going to be over a long time period. You need to decide your method of calibrating expected returns. That's a big issue that we're going to go into a lot of different ways. But do I use historical means? Do I use implied views? Do I think I know better than any model and just put in my own forecast? So we'll go through those two. You need to consider costs, taxes, video, every asset class that you see here is before costs are subtracted. There are only two asset classes that you guys will look at where some costs are subtracted, and that is hedge funds and private equity. Hedge funds and private equity, the data is after subtracting management fees. But all of this data, because that is the way it's expressed in the database, but all of this is without considering costs. So you need to remember that this is going to give you a pre-cost return, but when you trade, you incur costs that can differ between investors. So for example, remember, bid-ask spread will reduce the return you get. Brokerage costs and management fees will differ between investors. Taxes are going to differ between investors. One, because they have different marginal tax brackets. Two, because with capital gains tax, how long you've held the investment will affect the capital gains tax you pay. Does anyone know how long do you need to hold an asset before you qualify for a discount? A year. And do you know what the discount is? Do you want to say something? It's half. If you hold an asset for, and there are some provisions we can apply to it, if you hold an asset for over a year, then you essentially, you get a 50% capital gains tax. So you only need to pay capital gains on half that. Sorry, you only need to pay tax on half that capital gains. So what is your marginal tax bracket? How long have you held the asset? And all of these will affect whether it's actually an attractive investment for you. You have the issue of alpha, right? Remember, you might have an asset class that gives you a really high return. But if that high return is just compensation for risk, that doesn't make it an attractive investment. What you want, ideally, is alpha, which is additional returns after adjusting the riskiness of a strategy. So we're going to look at alpha a lot in week 5. Now in this course, a lot of this is going to be qualitative considerations. So for example, if you think that a particular asset class is very expensive to invest in, but you don't have the cost data in the assignment, I'm not going to ask you guys to somehow come up with an estimate of the cost of your collateralized commodities futures fund or something like that. But I do want you to consider cost qualitative. So when you come to, for example, the alternative asset classes or the illiquid asset classes, and your data doesn't have a cost included, you might want to say to your investor, you need to be aware that this particular strategy is quite expensive, and as a result, I haven't suggested a high asset class rating. That's just an example. It depends on what you decide is right for your investor, but there are things that even if you don't directly model it, you can consider it in your qualitative overlay judgment. How do you treat assets that don't have a reliable data history? So for example, new assets don't have any data history, so you're going to have to, if you want to do a quantitative analysis of it, you'll have to somehow model what that history might have looked like. Thinly traded assets or assets with appraisal valuations, remember that leads to smooth return, and I'll show you a numerical example in the workshop. You've got an issue of survivorship bias and selection bias, which can overstate return and understate risk. I said example hedge funds. Let's start with survivorship bias. We now have some decent databases for hedge funds. They're not great, but they're decent enough. But let's say that they didn't exist. And let's say that you guys wanted to create the first hedge fund database. So what would you do? You'd go out to the hedge funds that exist, and you would ask them to give you a historical data field. And let's assume that this is a really lucky world, and every single hedge fund that exists gives you their data, all the way back to inception. So for some hedge funds will have 30 years of data, some shorter, but you've got a long data history for every hedge fund that exists. That might sound pretty good, right? But what is one problem with that that we would call survivorship bias? What are we missing? They are the good performers, and why do we know that they are the relatively speaking good performers? Yeah, they exist, they haven't gone insolvent, they haven't gone out of business. Right, think about it. If you only ask the hedge funds that exist for their returns, what you don't have is the ones that have already crashed, that have already died, right? Because once they do, they're not there to get the return series from, and you might not know that they were ever a hedge fund in the first place. Now, there are many reasons why a hedge fund would close its doors.
Maybe the manager retires and no one wants to take over. But for the most part, chances are if a hedge fund has shut up shop, it's because it's lost all its money. So those returns, those negative performers aren't in your database. Worst case scenario, what's the worst return you could get if a fund's going out of existence? So if you lose all your money, what's your return going to be from one period to the next? Negative 100%, right? Can you imagine the impact that would have when you average it across all of the different investments? You don't have those negative 100%, the complete losses. So that's survivorship bias. It's that only the survivors are left to tell you their performance. So every fund that's done relatively well, that's still around, is using their return. Now, as time goes by, that problem lessens because even if so let's say you now have all of the history, and then you keep maintaining that database for the next few decades. For the data that you have at the start, when those hedge funds go out of business, you know they exist. So you can control for their delisting returns. In other words, if they lose all their money, you can have a negative 100% return. If investors get a small amount back, that might be a negative 90%. So you can start to reflect the cracking of hedge funds as time goes by. Even though you still had survivorship bias at the start. But it is still a major problem. And some databases just don't bother to track the ones that don't exist. So when you look at a database, you've got to be very careful to see whether it's survivorship bias free. So for example, for mutual funds, I do a lot of work on US mutual funds. I'm really lucky because I have the crisp survivor bias free mutual fund database, and that's so important it's included in the title. It's really valuable to have a database where you don't have survivorship bias. But when you do, you've got to remember that your average is going to be overstated relative to the true universe that exists. Selection bias comes back to that issue of the good performance, and this one we've spoken about already. Let's say, remember how I said you were really lucky and every single hedge fund gave you their data? Now let's get more realistic. Hedge funds don't need to tell you their return. So when you ask them for your data to put them into your database, the ones that have done really badly probably won't give it to you. And what if you're a hedge fund that you've done really well for the past 10 years, you've been around for 20, but you've done really well for the past 10, and you don't need to give me the whole data set. It's probably only going to give you the last 10 years, right? Because what's the value in giving a data provider your return series when you've done really well? What extra function will it serve? It's essentially a form of marketing, right? If you are advertising what your returns are, you're telling me that you don't want to do that if the returns aren't good. So that's survivorship and selection bias. Both of them can create an issue by overstating return and understating risk. You might have asset classes that they've been around for a while, but they don't have a good database to work with. And the classic example here is unlisted infrastructure. I've said this before, and I'll say it in the assignment workshop. If you want to recommend infrastructure as an asset class for your investors, a common solution that is good enough for the assignment is to model infrastructure like a direct property investment. Because in week 8, we're going to talk about the fact that infrastructure and direct property do have a lot of parallels. Some differences, but a lot of parallels. So for the purpose of the assignment, rather than saying a 10% weight direct property, you might decide that of the 10% weight that your optimizer gives you, and if you see it as an amount, maybe you might want to split that up between infrastructure and direct property. You don't have to, but it's an option. And I will go over that again once we've got the assignment. And of course you need to allow for parameter uncertainty and model uncertainty because these are only estimations. You're never going to be convinced that your parameters are correct and that your model is an accurate representation of the world, which is why you should avoid relying on a single model. And it's why if you come up with an unexpected result in your asset allocation, a too big or too small allocation on an asset class, go back to your input assumptions and say, well, these parameters are estimated. Maybe I overestimated expected returns or underestimated risk or the reverse. And you want to have a look at how sensitive your outcome is to small tweaks in those assumptions. So there are some decisions that you have to make. You know how I said it's quite a heavy week? What I think I'm actually going to do is give you guys a double break. They won't be long breaks, but there'll be two of them. Let's take a 5-minute break so you guys can sort of clear your head a bit, and then we'll go into the specifics. So it's 3:07. Let's come back at 3:12, and then we're going to start going into these reports now. And by the way, I've only got numerical examples for the workshop. Whatever I don't finish, we're going to do it tomorrow as well. All right, everyone. So now we're going to get into some of the specifics of the choices that we need to make. We're not going to go through this slide in detail because you already did it in the workshop, with the exception of the bottom bit, which I'll come to. But the reason that I've included this is, remember how I said you've got choices with your data? And remember how I said that a lot of this course is about tying together concepts from different weeks? Even though we've already covered it, I've put it here as an example of the fact that something that we looked at in a prior week is directly relevant to what we're doing today, because even something as simple as your choice of whether to use the arithmetic or the geometric mean will affect your outcomes. And in particular, if you care about wealth accumulation over time, if you use the arithmetic mean, you will overstate your return. So remember how I said that you might have an investor that asks you to achieve a return of 8% per annum, and as long as you have at least 8% per annum, they want you to minimise risk. If you calculated that 8% per annum using an arithmetic average, but they have a 5-year investment horizon, then you will think they've reached an 8% per annum return, but they haven't, because you should have used geometric return because you're compounding over a 5-year period, right? So you actually haven't satisfied their objective. So it really matters to use the right measurement based on your investor. If you have a log normal distribution, then you can say approximately that the arithmetic mean is equal to your geometric mean plus half your variance. The reason I wanted to show you that is to stress the fact that the more volatile your asset class series, the bigger problem you're going to have choosing arithmetic mean when you should have chosen geometric. So think about things like Australian equity. It is a volatile time series. It's a volatile asset class. World equity, same thing. And that means that you're also going to create a bias between the asset classes. So not only are you going to overstate your total portfolio return, but you're going to overstate the performance of your volatile higher risk asset classes more than your lower risk asset classes. So again, what you're doing is you're biasing the investment towards the higher risk class because you're overestimating the return per unit of risk. So you've got a problem in general across the portfolio and a problem in terms of tilting towards higher risk asset classes. And all of that problem exists just because you chose the wrong calculation. Okay, so it's all about choosing the data to fit the purpose. So the first big decision, the choice that you need to make is whether you're going to use data-based or model-based methods of estimating your inputs and of analysing the data. Now, I remember I was the same when I first started learning this concept. For some reason, non-parametric and parametric methods sound far more complicated than they actually are, particularly in a course like this, which is why I tend to use data-based and model-based, because it doesn't, I don't know what it is about the word parametric, but I find that students do the same thing. Remember, you've actually done both of these already. So non-parametric or data-based methods are just focusing on the historical data series. You might choose to adjust the data series by imposing an expected return, and you're going to look at that next week in your Excel video, but you're basically focusing on the past to represent the future. One way of doing it is to simulate by randomly drawing on the data. Excel video 1, your bootstrap, that's exactly what you did. Right, so remember, in video 1 you had a historical data series of yearly returns. We don't need that anymore. Historical data series of yearly returns. Moving into the bootstrap, you included all of the different years, there were 33 of them. You said each of those years had an equal chance of occurring, and we're only going to use equal weights in the bootstrap for this course. And you had particular asset weights that gave you a return on your investor's portfolio and a return on the peer group, which is what you have in columns D and E. All the bootstrap does is it's like putting every one of those years into a massive bowl or a lottery thing, ruffling it around a bit and saying, all right, well, if my investor has a 5-year horizon, I'm saying any of these years could occur again. They're equally likely to occur again. So over the next 5 years, it could be any one of these with equal chance. So I'm just going to pull out a number, and that's going to be one potential outcome for next year. So the first simulation that you run, if we take these numbers, the first number you pull out is 15. So you're saying, all right, well, next year, returns could be like they were back in 1999. You put the number back, pull out another one, 33. You say, well, 2 years from now, the return could be like it was in 2017. 3 years from now, the return could be like it was in 2013. 4 years from now, the return could be like it was in 1990. 5 years from now, the return could be like what it was in 2001. So that gives you a potential return path for the next 5 years, but only one potential return path. You then do that a second time to get a second potential return path. You do it again and again. In the Excel video, you did it 1,000 times. Does anyone remember what I recommend for the assignment? 10,000. I mean, the more the better. 10,000 is more than enough, right? I mean, there's nothing magic about the number 10,000. It's a nice, round, big number that will give you a better characterization of the distribution than using it only 1,000 simulations. So then you have 10,000 different options for what the next 5 years could look like. Because your investor has a 5-year horizon, you then accumulate those returns over the next 5 years. Right? So if your investor started with $1 million, at the end of 5 years, in the first option, they'd have 1.487 mil. In the second option, they'd have about 2.5 million, and so on. You can then translate that to an annualized return. You've now got 10,000 different options of what your annualized return would be for the next 5 years. You average it out to get the return that you expect per annum for the next 5-year period. And that is what you calculated here. Okay, so this is your non-parametric method of performing a bootstrap simulation. In the assignment, if you want to do this, if you have a 3-year horizon, you'd only have three columns. If you had a 4-year horizon, you'd have 4 columns. But you're just modifying the setup that you've already learned how to do. The next method, which is to use historical data to analyze a hypothetical portfolio, you have done that in Excel video 1, but not in a particularly good way because you don't have a lot of data points. What we mean by analysing a hypothetical portfolio is we take the history exactly as it occurred as a representation of what could happen in the future. So we say hypothetically, if we went through the exact same 33, in this case, years of data again, what would our return be? Now, the reason I say it's problematic, there's a couple of issues. That's what we've done here. We've used yearly returns, and we've averaged out the performance over that year for each asset class. Now, the first thing I'll say is on yearly returns, you've only got 33 data points for this particular setup. If you make an asset allocation call that your investor puts millions of dollars into, that loses money, and the investor finds out that you had 33 data points to make that decision, they're probably not going to be very happy. Okay, statistically, it doesn't give you a lot to work with. And if you had decided that there was a structural break in the data, like you said before, such that you only wanted to consider data from the year 2000, imagine telling them that you only had 18 data points on which to work with. It's not a lot to put into your analysis. So if you want to use yearly data, there is a benefit to using a bootstrap because suddenly you have 50,000 data points if they have a 5-year holding period, 10,000 data points if they have a 1-year holding period, or whatever it may be. The other issue is we're just averaging yearly returns here. Now, let's say that your investor had a 5-year horizon. If your investor has a 5-year horizon, you should be looking at 5-year returns. Now, that's going to be an extra problem using yearly returns. It doesn't mean that you need to split your sample up into 5-year periods. You can use rolling returns, but you should roll them over the 5 years. If you have a look at your, well, some of you may have because it was available since last week. If you have already looked at your Excel video for this week's topic, that is what you're going to calculate this week. You're going to calculate rolling returns over a sample. So we have monthly returns. Let's say your investor has that 5-year holding period. What you're going to do is learn how to calculate 5-year returns. We're just using a log function here. 5-year returns, and you're going to roll it forward 1 month at a time. Right? So you're still taking advantage of the fact that you have monthly data, but you're doing it with a 5-year frequency. This is the type of thing that you would do if you were going to analyse a hypothetical portfolio. What I'm going to do in the assignment is show you how to convert this into something that is more specific to the assignment issue itself. Okay, but this is the type of thing that you're going to do if you want to apply a hypothetical portfolio in your assignment. And you're going to look, by the way, at how the decision is going to affect your standard deviations and your correlations. So that's all the non-parametric methods are. You're either just calculating straight from the historical distribution, or you're performing a bootstrap simulation and calculating it from that. Or you could choose a parametric or a model-based method. Now, if this is the case, you're going to put in a model to represent how assets behave. As I've said before, I have a hesitation in doing this for portfolio construction because I think most asset classes will violate something like a simple mean variance model. There are other models that you could use, but they're outside the scope of this course because they're not really touched on in your more traditional finance courses. If you guys are doing actuarial studies, you'd probably know some of the other alternatives quite well. But personally, I believe that history is a better indication combined with an oversight of judgment and methods of estimating expected returns. Because if you assume a normal distribution, you're going to lose any skewness, which is wrong for hedge funds, wrong for private equity. You're going to lose any excess kurtosis, which is wrong for most asset classes, but particularly for things like public equity, right? If you think about collateralized commodity futures funds, which is one of the 2 big ways to invest in commodities, they're derivatives. So you're going to violate a normal distribution. You might invest in options to hedge your exchange risk. So you've violated a normal distribution. So there is a lot of issues with using mean variance. If you choose to use a mean variance assumption in your assignment, and you might choose to, you'd need to be very careful in how you justify it, knowing that your I'm not going to be marking your assignment, your tutors are, but knowing that the lecturer of the course and therefore the tutors as well have some skepticism when it comes to using a normal distribution assumption. The other thing is the normal distribution is kind of annoying to model, right? I mean, let's say that you want to do a parametric optimization assuming a normal distribution. Well, you're going to have to do the same simulation 10,000 times and convert it all based on the mean and standard deviation, which is what this is all from Excel video 1. If you make errors in your mean and standard deviation, you don't have the data history to rely on here. You have 2 figures that you're imposing on a normal distribution, and they could be very wrong. So you could, but I don't see it done often in assignments, and I think there's a good reason for that. You might choose, if you're going to look at things like estimating expected returns, that's slightly different because there are models that have been shown to help you. Now, if you want to think about an equity portfolio, which we're going to look at a little bit in week 5 and more in week 6, you might want to choose the type of factor-based models that you would have learnt in investments. So the CAPM, Farmer French, Carhart models, maybe look at industry factors. Now, these have potential, and particularly the CAPM, because you're going to see in next week's video how that can be extended to a multi-asset class level in a method that we call implied views, which I'll come back to. But just quickly, the CAPM, so we all are up to date. Expected return on an individual asset is equal to the risk-free rate plus what? Beta? times the market risk premium. So expected return on the market less the risk-free rate. Farmer French starts the same way as the CAPM. Risk-free rate plus the beta times the market risk premium. Then you've got a second beta. Does anyone remember what the next beta is? Or the factor is? Small minus big. So we're going to say size. And this is called SMB, but the way to calculate it is it's a factor sort of return on small stocks less the return on big stocks. The idea being that small stocks can command a premium due to higher risk. And there's what we call the value, if you like, premium. What's this factor called? HML, a high minus low, which is the return on stocks with high what? Book to market, less stocks with a low book to market. Then you have Carhart, where the expected return on an asset is the same as all the Farmer French, plus one extra factor, and what's that? Momentum. We're not going to look at these in any great detail in the course. We'll touch on them again next week and again the following. But so this is winners less the return on losers. So that's the return on stocks that have had high returns, the top decile over the past 3 to 12 months, less the return on stocks with the worst returns over the prior 3 to 12 months. The reason I wanted to start with talking about this is that you would have covered this in investments, right? We're going to do something similar in the context of implied views. We're going to focus on the CAPM, but the method of implied views takes this model and applies it at the multi-asset class level by saying the expected return on an asset class is equal to what you decide is the risk-free rate plus the beta of that asset class with a peer portfolio times what you decide is the market risk premium. And I'll come back to that in a couple of slides. So factor models can be altered to suit the multi-asset class purpose. And you will do it in the video in week 5. Now, just because I say that there are issues with assuming things like a normal distribution doesn't mean you should just take the history blindly and not condition on any other information. Because remember, the next decision we need to make, first we decide, do we use a broad data-based or model-based technique? The next decision we say is, well, are we going to assume IID unconditional returns? Or is there information we can condition on that will improve the accuracy of our parameters, our expected return, variance, covariance? So at the end of the day, it's going to depend on the asset class, and the question you need to ask yourself is why would you expect a conditional forecast to be better than an unconditional assumption? Now, your classic unconditional assumption is just to take the average of what's happened in the past and use that as an expectation for the next period's return. Right, so what we're saying is, all right, well, if an unconditional assumption is that next year's return is the average yearly return of the past 20 years, what you then ask is, could we do better for any reason than just saying that? Now, there is one wonderful example, there's several, but the classic example of when you don't want to use an unconditional assumption is in interest rates, is in fixed income, right? Because have a look at, this is a series that unfortunately wasn't updated in the latest yearbook. This is from your week 6 supplementary readings. It only goes to 2013. I'm going to show you some up-to-date examples on Australian assets in a moment. But have a look, because it's a beautiful illustration about how in many different countries, from the start of the 2000s to 2013, the real yields are plummeting down and actually turn negative in the last couple of years of that sequence. By the way, now real yields are uplifting into positive territory even for countries like the US, but it's only just and it's slow. All right, so let's say you're sitting at the end of 2013. If you use an unconditional assumption, you would say that the average real yield is the average of this series, right? We're talking about 2% for most of these countries. So what you're saying is even though real yields are currently negative, next period, suddenly we're going to go and reverse several years worth of interest rate cuts, several years worth of drops in the real yield. It doesn't make sense. Why would that suddenly happen? And to show you just how important that can be in the Australian context, let's take it to current data. I'm going to show you the actual data first, and then some other other forms of fixed income to show you the trends. This is Excel video 1. This is Australian cash. Now, remember how I asked when you guys wanted to start your data period, and you said 2000s? In the back of my head, I went, oh, damn, because that's actually a really good, relatively speaking, choice for Australian cash. Because Australian cash has had a massive downward trend. So if I was going to force you guys to use a historical average for cash, the shorter the sample period on which you're going to take that average, the better. Because remember, since 2000, the average cash rate was only 4.5%. Over this whole period, the average cash rate is 7.21% a year. It started in 1985 with cash rates of 16%. Can you imagine that now? I mean, oh my goodness, if I could invest in cash at a 16% return, I'd never even bother to pick a stock. I'd be so happy. Right? I mean, that's a brilliant return. And then you watch it fall, and it falls, and it falls, and it falls. And then it rises a little bit in 2009, and then it falls. And so by using an average of 7.21% as what you expect cash to give you next year, you're essentially saying that cash will be at a rate that it hasn't been at, with the exception of 2008, that it hasn't been at since 1996. It's just not going to happen. Now have a look at this graphically. Underneath this slide this morning, so sorry if you downloaded it before, it won't be there, but I was playing around this morning. I've given you a couple of websites that are really good to go to if you want to actually see some of this economic data. The RBA obviously is going to give us our Australian statistics. Trading Economics gives you a range of good things, and it's often going to give you some nice charts. Fred2 is the database, but the St. Louis Fed gives you a lot of quite useful things, mostly US, but also global, and it's got an Australian series as well. Let's start with the RBA data, and let's start with the Australian cash rate. Now, this only goes back to about 2000s. You can see the peak, relatively speaking, the peak in cash at a bit over 7% in 2008, and then watch it fall over the next decade. This is a clear downward trend. So let's face it, if you're going to model the cash next period, you should be looking down here. You should not be looking at the average. If you want to have a look at 10-year Australian government bond yields, clear downward trend since the start of this century. If you want to look at different countries, clear downward trend around the world. I'll come back to this. If you want to have a look at, no, that's not the one I wanted, this one. The corporate bond spreads, you can see a spike in yields in economic crises. Again, that's something that you could condition on. It's predictable to an extent. This is a chart of 10-year Australian government bonds. And you can see that back in the early 80s, they were above 16% yield. They're now around 2%, towards 3%. There's no sign of that trend reversing. It's certainly not going to reverse a couple of decades worth in a year. And if you have a look at this, so this is a long-term bond in Australia. Have a look at the 90-day, the 3-month bill. Since the early 90s, or the late 80s, it dropped quickly in the early 90s and stayed relatively flat since then. You can't take an average as what's going to happen next period. And I'm particularly jealous of this because when I hear I don't know if I've told you this, when I hear my father talk about the late 80s. He actually inherited some money in the late 80s. And he's an avid fisherman, and he's got this tiny little fishing lodge that he goes to all the time. He actually paid for the build of that fishing lodge by rolling over 90-day treasury notes every 3 months, just, yeah, put it in again, roll it over, because he was getting nearly 20% interest on that amount. He did that for a while, then just took the money out, and suddenly he'd funded building an actual little fishing lodge. Right? It doesn't exist nowadays. I can't even imagine a world where I could get a 20% yield from investing in a government security, right? A safe security. And I'm really jealous of that, but hey, it happened. He also, I don't think, had a mortgage at the time, luckily, so he didn't even have the double whammy of high mortgage rates too, so. Nowadays, I shopped and shopped and shopped and was really proud of finally at one point getting like a 4% interest rate. And it was an introductory rate that has now disappeared and is about 1%. So I've really got to move it. Okay, so if you're going to have a downward trend like this, you do not use a historical average. It would be completely inappropriate. It wouldn't reflect today. So there are some cases where it's really obvious that you can condition on information. And as long as you're a dancing monkey's intellect, you can do it. But there are other cases where you need skill involved. So even if one person could condition on the information, doesn't mean everybody can. And that would be things like mispricing of assets, because you need to identify whether they're mispriced before you can trade on it. So the next thing you need to think about if you might use a conditional assumption, so remember that's not using the historical average as your expected return, but using some kind of conditioning information to better improve that prediction, you might think about mean reversion, or broadly speaking, a slow trend toward fundamental value. So let's say that you think that the equilibrium interest rate isn't 7%, but you might think it's 5% over the long run. You might think that they're low now and they're going to start to come up. I mean, the US is already going up. All year we've seen rising interest rates. Now let's say that you think over the long run it should be 5%. It's not going to get there overnight, but you might condition for a 1% rise over the next year, and then another 1% rise, and then finally after 3 or maybe 4 years reaching that 5% equilibrium rate. So you might want to work that forecast in. You might consider whether risk premia follow a mean reverting process. So let's take the GFC. Everyone was scared in the GFC. Risk aversion was high, and people were putting a very high price on risk. So because of that, the equity yields were very high, and that meant that the equity values were very low. The safe government bond yields were low, so there was an elevated equity risk premium, right? The future return that was being offered by equities was very high because the current value of equities was very low. Once you got past the GFC, as equity markets recovered, equity yields came down. And it's a really important thing to remember. When equity yields are high, values are low. As equity markets recover and the value comes up, at some point it has to run out of steam. So the potential for future returns starts to go down. The yield goes down. You've got a good yield in the past now. So let's say that equity markets have been rising for 3 years. If you've been in equities, you've got those 3 years of gains. And they're rising, but there is always going to be some form of relative limit before things turn again. So your future capacity for gains is now lower. Which is why I say that if you ever want to get into the equity market, get in when everyone else is hurting because their portfolios are plummeting through the floor. Right? You want to get in at the bottom. So that is a trend that is to an extent predictable. You might want to condition on where you believe you are in the equity market cycle. Obviously, you need to have some kind of skill in identifying that. If assets occasionally become mispriced, you might want to trade before that price corrects. So if you think that an asset or an asset class is undervalued, purchase it now and enjoy the uplift when eventually it rises back to its fundamental value. But remember, you've got to consider the pace of reversion because it interacts with liquidity. You might not be able to afford to wait for asset values to correct. And that's exactly what happened with long-term capital management. Eventually, remember the hedge fund that collapsed? Eventually those trades did converge. If they'd been able to hold on to the trades, they would have made money, but they went bust before they had a chance. So if you have a lot of calls on your cash, so liquidity is important, that might limit your ability to trade on mispriced assets because you might not be able to wait until the price moves to its correct value. So the next decision that you have to make is what data you're actually going to use. Now, to some extent, this might come down to your actual data availability. You can only use the data that you actually have. So, for example, you might want to use weekly returns, but if your data series doesn't have it, too bad. You've got to move the closest you can to what you'd like in an ideal world based on what you have in reality. So if you want a short interval, go as short as you can based on the data series that is available to you. Think about your measurement intervals. So now, if possible, you'd want to align this with your investment horizon. So if you have a 3-year horizon, you might want to have a 3-year measurement interval. But remember, there's a difference between a holding period and a review period. So let's say you guys have 2 potential investors. One investor only cares about outcomes over the next 3 years. They don't care about the interim. They will not need to pull down on that cash, or that they won't need to redeem their money from the fund. Now, given just a 3-year horizon, you might just focus on 3-year returns. Do all your analysis on 3-year returns. If you have another investor that broadly cares about returns over the next 3 years, but is going to monitor you every quarter, that might need to pull on that during the 3 years, to redeem some of the money during the 3 years, then you might want to have essentially 2 horizons in mind. You might want to look at measurements over both a 3-year horizon, using 3-year returns and using quarterly returns as well. So that might be, for example, that you want to achieve a return over 3 years of an amount equal to 7% per annum, but you want the probability of loss based on quarterly returns to be no more than 10%, whatever it may be, right? So there you can see you've got constraints on both the 3-year and the quarterly horizon. So your investor in the assignment might end up having a requirement to look at both. You might have a tracking error constraint over a year and a cumulative return goal over 3 years. It just depends on whether your whether you have alignment of review and holding periods, or investment and review periods. Think about the influence of serial correlation, appraisals, and thin trading. Remember, the issue with particularly appraisals and thin trading is when you've got a data series that doesn't show a change in value, but it's only because it hasn't been traded or the appraisal hasn't happened. Right? It might be that the value of an asset class is going up and down all the time, but because it's not being traded, or because someone isn't coming in to record its value, it's not actually showing in the history. Now, by very definition, if you've got a thinly traded asset, the longer your measurement interval, the more likely you are to capture trades. Because if it's not happening often, then if you're only looking at the space of a week, pretty low chance that you're going to have a trade in that week. If you're looking at the space of a year, there's a greater likelihood that a trade's going to happen during that year. Same thing with appraisal valuations, right? And in this case, it's true by construction. If you look at weekly returns, 51 of those weeks, you will not see a change in value if the appraisal happens once a year. Okay, so what that means is when you have appraisals, when you have thin trading, the longer your interval gets, the less of a problem it is, right? So if you move from monthly to quarterly, less of a problem. Better yet, move from quarterly to yearly, less of a problem. Be careful about going too much beyond a year because you need enough data points to analyze, right? But ultimately, when you have that issue, it tends you towards the longer measurement intervals, so things like yearly returns. And we're going to see in the workshop how that's the case for serial correlation and for appraisal-based valuation. But then you've got that trade-off, and that is that the longer the interval, the less data points that you have. So these things, you tend to find that particular methods suit particular intervals because of the trade-off that exists. If you want to use yearly returns over a 20-year period, probably you don't want to use a hypothetical portfolio where you're only using 20 observations. You'd be better off using a bootstrap because that gives you more observations to work with, more data points. If you want to use quarterly intervals, then even with a 20-year period, you've now got 80 observations. So you've got more data to work with which means you can afford to analyse a hypothetical portfolio. You don't need to run a bootstrap, which is a good thing because a bootstrap doesn't perform well under serial correlation. And when we've got thinly traded or appraisal-based assets, remember we just said the shorter the measurement interval, the more likely you're going to have issues with smoothed returns and serial correlation. And when we go into the assignment workshops, I will give you examples of why you want to tailor the method to the measurement interval, which basically means I'm going to say the exact same thing but apply it to the assignment. Now, geometric and arithmetic means coincide if the interval and the holding period are the same, but the second you have a long-term investor, that's going to break down, which means it actually is really important to use the right method to fit the purpose. When it comes to picking your time period, this is the issue that I said right at the beginning of the class. If you have a long time period, you arguably have, well, you do by definition have the potential to see more extremes in the data. Extend it back not to 1937 but to 1927 and you capture the Great Depression. But at the same time, you've also got all the other periods where there weren't extremes. And the risk is that if the past was less volatile in general than the present, by having a long data series, you might actually wash out some of the extremes you see today. So if you think that there's been a structural change such that data in the 40s, 50s, 60s, 70s isn't a good reflection of today, then you wouldn't want to go back all that way. You'd want to start more recently. Now, luckily in this course, part of that decision is made for you because you're going to need to have data on every asset class that you consider in the assignment. Now, you can go back to the 1920s for equities, but you certainly can't for other asset classes. You can go back several decades for bonds, but really when you want every asset class in there, you're limited to start somewhere in the 80s or the 90s, depending on the method and the data interval that you use. So then your question is, do I use everything? Do I start in, say, 1985, when I then have data for everything? Or do I want to wait and start my data period later? But remember, then you have less data points, so you'd need to justify why that is still a valid, why you still have a good representation of the distribution of returns. Please don't, though, start to pick periods out of your sample period. Without fail, there'll always be one or two groups where I go, God, those returns are looking really high, and they've run, say, a bootstrap, and I look into the bootstrap and finally realise that there's a footnote somewhere in the assignment that says, we don't think a crash is going to occur, so we put the probability of essentially 2008 and 2009 happening at 0%. Right? Don't do that. I mean, if you have a look at what's happening in the world at the moment, Vanguard, as you know how I said last week, people are coming out to say, oh, there are problems. There's a new one this week. Vanguard's come out and said a crash is going to happen. They've raised the probability of a crash happening by 2020 to about 40%, which is quite high for them. We've got a crisis in Turkey. Things are not, there is a good chance that things will not continue to be as good now as they have been in the past. There's a reason, we're reaching a historical high in terms of the length of the bull market, of the S&P 500. Doesn't mean it's going to continue that way forever. So don't take out crashes unless you have a very good reason for thinking that nothing bad is going to happen. And I probably won't be convinced. Or your tutors who are marking it. So you've got to, I mean, there's no one right thing to do. There are some wrong things, but no one right way to go about it. Whatever you choose, the advice I want to give you is have a look at the data. Draw charts, run diagnostics. Try to stress test your assumptions, your choices, to see whether if you'd made a slightly different choice, your outcome would be very different. So, for example, have a look at whether there are outliers in your data and whether that's going to influence your results. I remember there was actually... How we go? Okay. Ooh, sorry, I said I was going to give you a second break and then I completely forgot about it. Sorry about that. I remember I was at a conference in Chicago and there was a really cool paper being presented by this person that was on the job market, and I loved the results. I was getting really excited by it. And then the referee stood up and he said, if you remove just 2 months from his sample period, every single finding in the paper actually reversed. You've got to be really careful that you don't have outliers that are driving the data. It's also really good to take your sample period and split it up into subsamples. Because you might have run a trading strategy over the past 40 years and on average it's produced really good returns. If you then subset it and find out that for the past 15 years it's had negative returns, and that positive return has actually been driven by the first 25 years of the period, you'll be really grateful that you did that subsample analysis, because the strategy doesn't work anymore, and if you did it now it would lose you money. And that happens a lot because anomalies exist. Trading strategies are profitable, so people do it, and then it's essentially traded out of the market after that. So look really carefully at your data. Now, I'll just start off this next part by the next part of the lecture today is talking about the key input and the most sensitive input in asset allocation, which is deciding your expected returns. And I absolutely love this quote. I'm not going to read it word for word. I'll leave it for you. But can you imagine, it was Merton Miller talking about Miller and Markowitz and Sharpe, all won Nobel Prizes, right? Markowitz, modern portfolio theory, Sharpe lit in the CAPM. And when they were going through the process, they were given a serious ribbing from the scientists around, because we spend our whole lives in finance trying to measure something that you can't actually measure, right? And so he said, well, at least the neutrino, however you say it, there was this particle that you couldn't measure. At least they had that was sort of similar, but since then, they've already figured out how to measure it. But we still don't know how to properly measure expected returns because we can't read into the minds of people. So it's a really important thing to understand, but it's really hard to do it well. So we have a few different options and a few different ways to go about it. The first is really simple. Take the expected return for next period to be the average of what's happened in the past. Now, if you don't have a good way of imposing conditions, of modelling what the returns might be, then that is a sound assumption to make. If you don't believe you have a better way of accurately predicting what equity return will be next period, then sample means can be justified. But remember fixed income, you cannot do it if there's a clear time series trend. Another option, which is what you're going to do in next week's Excel video, is to use implied views. Now, with implied views, and I'll take you through the steps in the workshop, but I just want to show you what you're doing. Essentially, you're calculating a beta like you would on the CAPM. Where's my beta? Here we go. You're calculating a beta based on the asset class and its correlation with a